how did we determine the price of the bond? It's a little bit of a harder, I guess, knowledge for you guys because the majority of you have never had a finance class. So thus you've never, unless in high school, you've encountered a principle of time value of money. Then you will know how to do that. So I will give you just enough to do the basic journal entries, and then if we have time, maybe I'll explain it a little bit more to you. So here's an example. Assume that Acropolis Company on January 1st, 2020 issued 100,000 9% bonds. So this is 9% is your contractual rate or stated rate. The bond is due in 5 years and interest is payable annually at year end. The purchase of the bonds would receive the following two types of cash payments. First of all, you are entitled to a principal of $100,000 to be paid at maturity, and it helps to draw a timeline so you can see the principal of $100,000 will be paid in 5 years. And then also at the end of each year, we will be paying $9,000 worth of interest. So how did we calculate that? You know that it's principal times times interest times time 1 year. That's how we got $9,000. Now, if I look at the, it will not be correct from the time value of money perspective to simply say 100,000 plus 9,000 times 5 or 44,000, 45,000, 145. It will not be correct. Why? Because the buying power of a dollar today is not the same as the buying power of a dollar 5 years from now. So these are almost different color dollars, right? So if I invest a dollar today, I'm going to get interest, right? So I will have a whole lot more money in 5 years. So what we will be doing a little bit in this class and in your future classes, you will discount these cash flows. Why would you need to do that? Well, as I said, you are right here in now, and you have future values of the principal, and you have future values of all the cash payments, interest payments. But what you don't know is what is present value of all these payments right now. So for discount, is either using a calculator, Excel, or tables, 100,000 received in 5 years right now in present will only be worth $64,993. Okay? Or basically, if I take this money, invest today at 9%, I will get exactly $100,000 in 5 years at 9%. And the same with $9,000, those payments are called annuity because they're the same payments in the same amount of time. So every year or every quarter, basically once in a period. Present value of those payments discounted will not be 45,000, they will be 35,000. So if you add these two, it magically agrees to $100,000. Okay. All right. So what kind of journal entries will we be dealing with? We will be dealing with bond transactions when we issue the bond or sell it, if we redeem it or buy it back if we've got the callable bond, right? And if you have a conversion from bonds into common stocks. And we're going to skip that for now. If a bondholder sells that investment to another investor, then the issuing company will have to do nothing because it doesn't really change any in the financial position of the company. So we will not have to journalize that transaction. Okay, so let's take a look what happens if we have a variety of interest on the market. So for example, here is my bond and the interest rate, contractual or stated rate, is 10%. Okay, what if I have exact same bonds like mine from other companies, and those bonds are also offered at approximately 10%. So market interest rate is also 10%. Okay, I really don't have any negotiating power, and in this case the bond will sell at a face value. So if the bond is, for example, 100,000, it will also sell at 100,000. Okay, now think a little bit as an investor. What if I'm offering, okay, you a bond, an investment, and I'm offering 10% worth of interest, and then everybody else on the market is only offering you 8%? Which bond or which investment is more attractive to you as an investor? Mine, that is paying 10% to you, versus everybody else's at 8%. Well, of course, you would want my bond as an investment because the interest is higher. Okay, too bad for me, but really good for you as an investor. In this case, I would say, I'm not selling it to you at 100,000 or at a principal or at a face value. I can demand a little bit of a premium. Okay, so I can say, hey, why don't you pay me right now $105,000, right? And I will repay you $100,000. Okay, could also have a third variation when I'm paying 10%, and again, you are a potential investor. In the market, on very similar bonds, everybody else is paying on average 12%. Okay, well, I'm in a pickle. I really need some cash. However, nobody really wants my bonds because I'm not paying enough interest. And I would say, okay, I know I will have to repay $100,000. Why don't you give me $97,000 cash right now? So I just offered you a discount of $3,000 because my interest payments are not as high as they could be. Okay, I highly recommend to study this chart, not memorize it, but rather think it through so you can understand it well. Okay, so what are we going to do if the bonds are issued at face value? Okay, so issued 100,000, 10% bond at 100. Okay, remember how usually bonds are expressed as a percentage of their face value. In this case, it will be a debit cash 100,000 and then credit bonds payable, very similar to notes payable. Okay, that's your long-term liability account. Okay, what if to continue we'll need to record and accrue interest? Okay, assume the interest is payable annually on January 1st, and our fiscal year end is December 31st. In this case, you need to recognize interest expense and adjust in journal entry. How did we get 10%? Remember our famous formula, principal times interest times time. So 10% of 100,000 is $10,000, and you will record it as interest payable. So this is really chapter 3 for you. Okay, what if tomorrow, January 1st, 2020, or I should say 2021, that's when we pay the interest itself. You will debit interest payable and then credit cash. So again, chapter 3 as a review. What if we issue bond at a discount? So in this case, 100,000 5-year 10% bonds. It was issued at 98 or for $98,000. So if you have a value of cash received lower than the face value of a bond, that means it was issued at a discount. And the journal entry will help you out. So we record cash received 98. Then I would say plug in bonds payable 100,000, and then you will have an account that we called discount on bond payable. Normal balance for that contra account is a debit. Okay, so normal balance again is a debit for that account. So if you think about it, you can either have a discount on the bond or you can have a premium. Okay, and a discount will be on the debit side, and premium, as you will see in the next video, will be on the credit side. Okay. All right. What will it look like on the balance sheet? So here's your partial balance sheet, long-term liabilities. So because the bond is not due until 5 years from now, at par 100,000, and look at that last discount, because remember this one was a credit balance, this one is a debit balance, it's a contra account. That's why it has to be subtracted. And here is your carrying value of the bond. Carrying, very similar to book value, carrying value of the bond. Okay. let's take a look. What's the total cost of borrowing? Well, you will have your interest payments, right? 10,000 at 5, 50 of those, plus you have the discount because remember you only received 98,000 cash, but you will have to repay 100,000 plus your 2,000. So total cost of borrowing is 52. So this doesn't take into account time value of money at all, just straight out math. Or you can do it in a different way. Principal at maturity, payment 100,000, plus your interest payments 50,000, 150 total, last cash received 98. That will give you the same $52,000. Okay, so what happens with time? You will get to amortize that discount. Okay, we won't be doing it in accounting 201, but in intermediate 1 and 2 you will be doing it. With time, over 5 years, as discount amortized, the carrying value of the bond gradually will change from $98,000 all the way to 100,000. So magically the carrying value will be equal to the maturity value or principal at the time we need to pay it off. So it will be exactly at $100,000. And then we'll just pay it off. There will be nothing in the discount. Remaining balance will be zero, all gone.